Hi, folks. Welcome to another episode of the Shut Up and Do It podcast. I'm your host, Nick Aalerud, principal with AA Real Estate Group and creator of the CompleteDealFlowSystem.com. And join us while we go through all things real estate while bringing you top quality topics and speakers, all who believe in a get-it-done manner. Today, I have the honor of introducing to you a friend and mastermind colleague of mine. His name is Mike Zlotnik, or as we call him, Big Mike. This gentleman has been around for a while. He's been started in real estate as a debt and equity investor in 2000. He was 15 years in the IT world, managing risk, business intelligence, and quality of complex systems. And he has passion had always been real estate. So he manages now a couple of real estate funds. He also wrote a book called How to Choose a Smart Real Estate Investment Fund, which is available on Amazon. And I'm sure he has more to his story that I will let him tell you. Big Mike, thank you for coming on with us today. Appreciate it.
Nick, it's an honor and a privilege. Thank you for inviting me. Appreciate to be here.
That is awesome. And the weather in New York City right now, fair shape?
Today is okay, but it's getting a little colder day by day.
I was getting sick of interviewing all these people from Southern Florida, Southern California. It's good to finally have someone in the Northeast up here with me. I appreciate that.
Boston is a little bit colder than New York, so if you feel cold, we feel a little bit warmer, usually.
Hey, Mike, if you don't mind giving everybody kind of a background, how'd you get into business? How'd you get into real estate? What were your passions? That'd be great.
Sure. I immigrated to the United States in 1989, a refugee from the Soviet Empire, from the evil empire, the Soviet Union right away. So I'm a U.S. citizen, been living here since 89. It's been 30 years. I live in New York City, family, married, 4 kids and a cat. I did spend 15 years in software development, had a career, successful career. And then I realized that what I really enjoy and love is real estate. So I switched, went full-time into real estate 2009, but started investing in 2000. And I do manage a few funds today, and the flagship Tampa Opportunity Fund. I do have a cute name, BigMikeFund.com. That's the name of the podcast, and that's our landing page. Again, Big Mike Fund, easy to remember. Mm-hmm. And if you misspell it, BigMikeFund.com, it is not a kinky site, I promise.
We'll put it in the show notes, and we'll also make sure people know it's not a dirty site. Excellent.
Yeah, so other than that, just enjoy real estate, spend time with the family. As a fund manager, has a lot of fun work, finding quality deals and quality sponsors, quality borrowers, and also raising capital, kind of wearing a couple of hats as a fund manager. And I invest obviously personally also in real estate, and that's it. That's what I enjoy most.
That's awesome. When you started the process, well, let me ask you this: from IT to real estate, what got you even passionate about real estate to jump in, either as an investor or as?
There's one word about it called predictability. Real estate is predictable. Everything else is not. Well, stock market is certainly not predictable. I very much enjoyed the career in IT. Just didn't enjoy work for a technology company. We deployed the software at midnight. A lot of teams, a lot of responsibilities to deploy software at night, make sure it works. So I just didn't want to work all these crazy hours on the weekends. I wanted to enjoy real estate. You make it as active as you like or as passive as you like. That's the beauty about real estate. You make investments, money works for you if you make good investments. And that's the crux and the essence of the exercise. There's certainly some active involvement, but in general, good investments are passive, and that's the beauty about real estate.
That's excellent. And when you started, did you know when you got into this, did you have your goal of building your 2 funds, or did that come later?
The original fund was started by a good friend who was also in IT, but he just started the fund, didn't really do much with it, and turned it over to me. And then we've launched a few funds as an evolution of our own deal flow and opportunities. So it's been a natural progression from doing hard money loans and fix and flip projects into opportunistic investments. Our flagship fund, Tampa Opportunity Fund, invests opportunistically. So as we went through, obviously, downturn and then the uptick and then recovery, lots of opportunities start coming up, and so we formed a fund to take advantage of these opportunities. Real estate is very opportunistic. You don't just invest because you want to invest. You always are looking for a good deal. There's got to be a reason why you want to make the investment. If you got nothing better to do with your money, I'm sure you can find something else to do. But if you make prudent investments, that's the crux. You make the money on the buy, not on the sell. And so I don't know if I answered the question, hopefully.
Well, yeah, when you started then, so you were basically an individual investor, maybe with a couple
Right.
partners, and were lending on other active partners, or were you guys doing your own projects yourselves?
Yeah, so I've been an individual investor since 2000, in kind of buying up whatever I could in New York City. It's pretty much investing only in New York City. You couldn't go wrong, really. I mean, the market has been appreciating, so you can only regret selling. You can't. Most people haven't lost any money here. Done pretty well. But in 2009, we started funding flips. So it was original transactional funding. We are both in CG. Jason Medley was running iVisionary, which was #1 transactional funder. We were #2 Tampa Funding, and the flips were kind of the bulk of the transactions. But after 2011, the short sales flips kind of slowed down. We had to fund extended funding. Essentially, had to fund holdings for a month, 3 months, and we did a lot of, it was they still call it transactional funding, and we rarely now do onesie, twosie here and there. But we start funding light rehabs, some bigger rehabs, just kind of naturally evolved because we had universe of people we've been working with, and if they're good at what they do, we evolve with what they do. So our whole model is based on relationships, not locale or anything else. We basically adjust, and if you're a specialist in something, and we have great relationship, we'll figure out what you need in your next iteration of your personal growth in real estate, and we will provide financing product, sort of almost like private banking per se. We're not a bank, but private finance, working with the top folks, trying to figure out what they need. Does that make sense?
Oh, yeah, for sure. No, it's good to hear that too. And it's funny because you mentioned the short sale flips in 2011, and I was right in the middle of that. We have a short sale negotiation firm, and me and my partner, Marianne, were actually flipping short sales back in the day until everything changed, right? And you had to close and hold or not flip, and you had to disclose. And transactional lenders became that was kind of the big boom of transactional lenders back then, right? I mean, that was...
Yeah. So transactional funding was really good 2009 through 2011. Then it froze up, literally. Bank of America came out with 30-day hold, Wells Fargo and a few other ones. And transactional funding as a flip funding literally disappeared overnight. Didn't disappear, but it slowed down a lot. So we've done that. We've effectively went into funding 90-day, 120 days to meet the anti-flip restrictions. So that was a basic evolution. And then if you're holding the property for 90 days, 120 days, and you have a rehab crew, you might as well improve the property. So they became light rehabs, and ultimately that was the whole game then. So
yeah, excellent. What were your biggest challenges, Mike, when you started opening and building your funds?
Well, funds generally have a few key. As a fund manager, there's a few functions that you as a manager deal with every day, and none of the stuff it's been sort of a progressive learning as I spent years improving as a fund manager. Generally speaking, as a fund manager, one of your key challenges is always raising capital, right? I mean, no matter what you do, no matter what are your investments, the capital is a challenge, and then quality deal flow. That's a secondary. Well, they're equal sort of in the importance category. You need quality deals, but I want to start from a different point. You need quality sponsors or borrowers, people who you work with. So you start with people first, and then you start funding their deals. And if you build strong relationships, you'll get to fund all or most of their deals. So the challenges are obviously finding quality folks who have deals. Again, as a fund manager, we don't look for deals ourselves. We look for people who do deals. The other side is capital raising. And as you grow, the challenge of managing a bigger fund, or at least a growing fund, is portfolio management. So we've evolved, and we certainly do 1 and 2 well, and we also do 3, which is 3 is the fund management. So those are kind of challenges that we're dealing with today. And it's not about, when you're starting, you don't have a portfolio to manage. So you just have to focus on 1 and 2, finding the money, finding the deals. Once you get bigger, you deal with the problem number 3, which is doing a good job managing your portfolio.
Absolutely.
And by the way, this is true on personal level too. Personal investing is a very similar concept, right?
For sure, for your own portfolio. But on your side too, I think you have an added complexity where you also have to kind of remain in contact and service your existing investors, right?
That is very true. That's a great point. So as a fund manager, you have investor relationships issue. And you have to, we use third-party administrator. That's the beauty about what we do. We outsource a lot of the work. We use third-party administrator. We use third-party auditor. And the administrator does all these statements for investors. They do distributions based on, they do all the fund accounting. So we don't have to do that in-house. That's the beauty about it. But we do have to maintain relationships. We do run quarterly calls. We do provide investors with periodic updates. So as much as they would love to hear, some people are active investors, some people don't care. They just want to get the check, and that's cool. So,
yeah.
But yeah, it's a good point. Yeah, investor relationship is important for sure.
So let's get to the greatest question that my audience loves to learn about. How do you raise capital, Mike? Let's talk about it.
So it's a complex question, right? It's not a onesie twosie answer. It really depends on what you're raising the capital for. Right. So if you're raising a capital for a specific project, that's one. A project could be small investment locally. It could be a significant project, a syndication, which you're raising capital from a bunch of people, and you have put together your offering memorandum, and you're trying to raise capital. Or it's a fund like ours, we're raising money. There's different complexities with different type of projects you're looking to raise capital for. Some people absolutely love individual project. They can understand. Maybe it's local. Maybe they can go touch the building that they're investing into. They know the terms, and that's what they're happy to invest with. Some people are perfectly happy with the fund, and some do both. So when you raise, you always start. Always start with friends and family, right? So if you have a good project, you're doing a fund, you're doing anything else, start with people who know, like, and trust you. It's really hard to raise money with people who don't know you, don't like you, or don't trust you. So it has to be all 3 of those things. If one of them fails, hard to raise money. But if you start with friends and family, and then you go into their referrals as a second tier, right? Mm-hmm. You have your tier 1, your close people who will give you the money. 2, the friends and family. Referral works incredibly well, right? People say, well, I'm going to advertise this and that. Ask for referrals. That will save you a fortune on marketing costs. There's a lot of people out there, friends of your friends, who have dollars to put to work. So once you exhaust your initial universe of close friends and family and their referrals, then you start figuring out what groups with money you can associate with. And now it's gonna go into a degree of complexity, right? So you certainly need to establish subject matter expertise. That's what people do education. Right? That's why I run the podcast. I'm not doing a podcast. I certainly enjoy educating. I enjoy spending time interviewing folks like you. We're doing this, reciprocally, if I pronounce it correctly. But the point is the same. If you educate, if you have book, if you have podcast, if you have a universe of folks you're influencing through the education you do, you could potentially reach out to these folks. But you have to be an expert. You certainly can't tell people baloney stories and expect them to raise money. You need to know what you're doing. So you got to have expertise, and then touch points to the folks who are out there so that they develop a relationship with you. Basically, to raise money, you got to establish. So during the old days of capital raising, most of the offerings were 506B. It's a regulation D. It's just if you put together a PPM or an offering. You had to establish a prior existing relationship before you could raise money from anybody. Today, with the Jobs Act, you could have a 506c offering. All that means is you can actually advertise. But we don't, because it's hard to get strangers. So the exercise comes down to people, attracting people to you, to know, like, and trust you. And when you have a deal, they're already sitting and waiting for the deal. So it's a long discussion, but as long as you are attracting people to you and what you do, and they understand what you do, and they think you are an expert, and you can generate good returns in your business, then they can line up to invest with you when you have deals. If it's a fund, evergreen fund, they can invest some money to start and see how you do, and then invest some more. But you're trying to get that relationship started somewhere. And I'll shut up in a second. I like the podcast. Shut up and do it, right? So I got to shut up.
No, this is good. This is good. You're good.
So one point is we raise money through a number of kind of professional groups with a lot of capital, but that takes relationship. They need to you need to be in the group, deeply involved with folks. We have some investors from the Collective Genius who know me well, but it takes time. And these relationships are worth building. If you build them and people know you, when you have a deal, you could call them and say, listen, I got a deal. Do you want to invest in a deal? Here are the terms. Or you could have, if it's a fund, it's a little different exercise, because for a fund, they're trusting you as a manager to make investment decisions. It's not a deal specific. That's the big difference between a fund and individual investment. You're making the decision as a fund manager. Individual deal, you have something to sell, very, very specific. Does it make sense?
It does make sense, for sure. For sure. We found it's like a mixture of, like you just mentioned, friends and family, like that personal touch, know, like, and trust you, right? Those are the three. Know, like, and trust you. We did find like a process to reaching out and keeping in touch with people, right? And by them kind of seeing what you're up to, seeing what you're up to, there's just a matter of time before they finally reach out, or maybe you're not even specifically asking them over and over again for, hey, invest with me, invest with me, invest with me. You're sort of just saying, this is what I'm up to, right? If you want to go for a coffee, let us know. We're here to talk to you. But there's almost like a system to that, but keeping the system as well as making it personal, I think is the art form. Would you agree?
Yeah, absolutely. Again, we're talking now investing capital from non-professional, high net worth individuals. I'm assuming most people, we only raise money today from accredited investors. We stopped raising from non-accreditors, flagship fund, accredited investors only. So you're absolutely right. You're not raising money. You're really just getting them to know you. And once they get to know you, they'll ask you the question about your fund. So you're not proactively pushing anything at people at all. When they're ready and they're aware of you, there will be a conversation. For sure, it's a little tricky when you have a deal and you got to close in timely manner, right? Mm-hmm. Yes, at that point, you have to have a trained universe of people that trained from the point of view they're ready to go. But until they feel they know, like, and trust you, like, again, like I mentioned, there's nothing to offer them, nothing to discuss. But it is the continuous touch points, continuously staying connected to them, newsletters, whatever else, podcast. It changes. The game changes quite a bit if you're going to raise money from family offices or institutional, right? It's another universe of complexity. We even, working with some foreign investors, which is yet another opportunity. But it comes down to personal relationships. Once there's a personal relationship and you cross that bridge first, then there is a consideration no matter where they are in the world. Because there's a lot of scams out there. Probably 5% of circulated deals are garbage. So folks who are prudent and they want to write smart checks, they got to feel really comfortable with you as a good steward of their money.
I love that you kind of just honed in on that point, because there's so many sites out there too, or even people on LinkedIn, right? Like, oh, just hire me. I've got, I've just seen so many scams like you just mentioned, but you just kind of brought it home, and it is still personal. At the end of the day, if you're raising capital, you have to be out there making relationships so that they know, like, and trust you as a person, which I love. So we talked about sourcing capital. Why don't now we talk more about the asset types that you like, and maybe where you see the market headed? We'll take them one at a time, one of those questions at a time.
Sure. So Again, I want to give you from my perspective, this the
That's what we
whole
like.
bigger
Big Mike's perspective.
universe of real estate deals that we don't do, but we certainly do hard money loans. We like the fix and flip loans, especially turnkey range, affordable housing. We still do quite a good number of these fix and flip loans with same folks that we've been doing business with for a long time. That continues to be decent. Because again, there's always aging houses, right? There's always older stock. There's always distressed properties. There's distressed sellers. Either case, it's an opportunity for a value add, a fix and flip, and then they need financing, right? So we continue to do that. That market is harder to get deal flow, but if you have relationships, we're still getting it. I do like a couple of other I'm going to sort of talk into a big buckets now, move into opportunities where we're shifting and we see tremendous opportunity. So New York City, and same thing. It could be in Boston. Could be a lot of big cities. Similar opportunity exists. So what are we talking about? Would I go buy a freaking building here at a price is there now? And the answer is absolutely not. Everything is overpriced. The cap price is so low. It feels crazy to get into these deals. Very, very hard to get into quality deal.
You said that everything in New York always goes up, Mike. I heard you say that. So
it has been going up, but at the same time, right? It feels today everything is priced for perfection, and we've seen softness in the market, especially high-end condos have been oversupplied, and that market has already softened up. So I'm not saying that the assets should be going down. I'm just saying what's a better way to enter into these assets with a high degree of safety. Right? There's a better way to do this. And a better way is to participate in or buy either the whole product or pieces of a syndication or a deal, distressed commercial paper. So distressed commercial first mortgages. I like that whole sector quite a bit. Why? Because you're basically participating at a low investment to value ratio. So you go into something that's worth, say, $20 million and you're buying a mortgage only for 10. So if the borrower defaults, you'll take the building that's worth twice as much as what you put in. And why distressed? Because the performing paper has very low interest rates, right? It's one of the challenges. I don't want to enter when the thing is performing because the interest rate is not attractive enough. But what is interesting when it defaults on a term maturity or some other technical default, and the default rate is now 18 to 24%. So that's what I like today. As economy likely going to slow down. Maybe not 2020 because it's an election year and we're still rolling pretty good. But there are already cracks in the ice. There's already some level of distress. And it could be distressed owner, not necessarily the whole market. So if you can find these opportunities where there's a distressed situation and you can buy distressed mortgage from a bank. And often banks that make a loan, banks love performing mortgage. They want to get their payments. When everything is good, banks are happy to hold it. The moment something goes in a default, the banks want out of it. Why? Because they have regulators. Anytime they have defaulted paper on their books, they have to increase their reserves. There's levels of complexity for the bank. And if you're a specialist and you can actually buy the paper from the banks, when it goes into default, banks love it, you love it because you could pick up paper with default interest rate 18 to 24%, late charges, and a very strong collateral value. That whole sector of these distressed commercial mortgages will continue to increase as the economy slows down. So I find that opportunity to be incredibly good risk-adjusted return on investments.
That's awesome. And you are buying it, like you said, you're most likely buying that note at a discount, being that it's distressed. Yeah.
You may, just to be clear, you may or may not get a discount. So if a bank made a $10 million loan, it's worth $20 million. The bank may not sell you for anything other than par. They can't charge you more because it's worth only $10 million. Can you get a slight discount? The answer is yes, it's possible. What is typical is this. Say it goes in a default and it has accrued $500,000 of additional default interest. And the bank is sick and tired with foreclosure, they want out of it. You come to them and you tell them, listen, I'll pay you the $10 million principal, but I'm not going to pay you the $10 million of default interest that's due because this thing is in default. And the bank may say, heck with it. Give me my $10 million, I'm done, right? Mm-hmm. So that's what I think if you mean discount, that's the practical discount. It's hard to get a discount if it's a 10 million paper and you will buy it for 8. You would get a discount if the collateral ain't worth 20. If it's worth 13, then yeah, I mean, you'll ask for a discount.
Gotcha. Would you ever consider doing a workout then with that primary borrower on a commercial?
I don't want the thing to reperform, right? My workout is, yeah, we may give you a fresh hard money loan at the hard money rates, right? But I don't want to give them 5% rate. What's funny is that these loans are written with bank rates. It could be 5% rate, maybe even lower, but the default rate is typically pretty high. At times at the maximum usury allowed level. New York, it's 24%. I think maximum usury 25, but they write the paper at 24. So can you do a workout? It's possible if you can restructure it, 10% rate. If you get card money rates, that's fine. But if they want their 5% rate, I want out of it. I want to get my late fee, whatever default interest, and go ahead, get 5% money from somebody else. So
I love it. That's very, very great. And if anybody's interested in knowing the state of the market, all you have to do is watch $1 Million Listing in New York, and you see it right there. That's how I get all my market knowledge. No, I'm half kidding. No,
don't wish to be. I mean, it's a show. It's the bottom line. It's a show. Well, what's interesting is $1 million listing, like $1 million in Manhattan. It's just this little entry level affordable stuff, and that stuff ain't going down anymore. It's the most affordable stuff. What is going down is the $5+ million condos, because supply is huge. So affordable stuff is still trading incredibly well. The high-end stuff has softened up quite a bit, might continue to soften up because of oversupply versus the number of folks who actually buy that product at the prices that it exists. So this is one opportunity that I like. There's plenty of other ones, but this is a sector, as economy turns and slows down, where the opportunities could be plentiful and growing. So I quite a bit like. The only side effect or negative is when you have defaulted paper, you're collecting payments. So you're accruing interest, but you're not getting it. So as long as you don't need liquidity and you can be patient for a couple of years worth of foreclosure. You're in Massachusetts, foreclosure is long too, but in New York, it's probably longest in the country. It could be 2.5 years. It's a beauty and a curse. The curse is it takes a long time. Beauty, you can accrue a lot of default interest. So the fact that it takes so long enables you to get pretty strong amount of accrued interest, which is part of the exercise. So
that's great. Okay, I've got one of our hot seat questions for you, Mike. This one is you get off easy. This one's an easy one here for you. Do you have any specific routines that you follow either in the morning or at night every single day?
Well, I do follow a lot of routine with a lot of kids. So I have 4 kids. I certainly try to build the routine so that there's time. It's a part of my routine is changing activities. So when I spend time with kids and drive them to school and pick them up from school, it's part of the routine. It's just you're socializing with your kids, you're listening to them, you're talking to your kids. So part of your routine is talk to your kids. First of all, it's learning both ways. Not just you educating. Sometimes the kids tell you information that is education for you. You may not realize it, right? So that is a part of the routine. But the other part of the routine is thinking, right? You have to think every day. So I find pockets. It could be first thing in the morning. So people have to get up, 5 o'clock in the morning, have their coffee and think about it, right? Say their prayer and do that. For me, the best time to think is when I drive to pick up the kids. I have to drive early because the spots are limited near the school. So I'm there extra 30 minutes. That 30 minutes is think time. I'm sitting there and I'm thinking about what's coming up. What are the opportunities? What's changing? And as an individual investor or as a fund manager, got to try to find what's coming up, not just what's happening today. And thinking helps. Obviously, reading helps quite a bit. But reading, if you don't analyze the information second or third time, you just it's one way, just got into your head. You need to analyze. So I would say thinking and analysis every day should be part of your routine.
Gotcha. I love that. That's awesome. So, Mike, you have a book out. You want to share with us what that book is? I said the title earlier, but
Yeah, the book, and I'm writing a second book, by the way, but for now, so this is the first book. I don't know if you could see this.
How to choose a smart real estate investment fund.
And it's top 10 questions to ask. So this book is written, Corey Boatwright helped me. You know, Corey through the Collective Genius is a brother from the CG Mastermind.
Yep, former guest on this podcast as well, yes.
Yes, so Mr. Boatwright is a close friend, and we wrote the book I wrote the content, he asked me the questions, I answered them. It was transcribed, and that's how the book was written. It's a whole lot easier to write a book instead of just typing yourself. So go through Q&A, record Zoom call, and then have it transcribed or edit it, and then there's your book. So, but the questions are great. It's the top 10 questions to ask before investing in a fund, and then it'll take you through a universe of questions. And this is true for a fund or a syndication. What questions should you ask? I'll give you a very quick preview, right? The real basic questions: what's the safety of my investment? And the moment you hear guaranteed, well, call Bernie Madoff. Most investments have a degree of risk and no guarantees. But as long as you understand what are the downside protection of whatever the vehicle you're investing into, whatever the project, if you understand what the project is all about and what is the downside protection, that helps you minimize your risk and losses. And then you go through further questions. What are the fees? What are projected returns? And so on and so forth. As long as you have a pretty good idea what you're investing into and you ask these questions, you'll be much better educated for the next project or next fund.
Hey, Mike, I can't thank you enough for your time today, man. How do people get a hold of you?
I appreciate that, Nick. So bigmikefund.com, right? Easy to remember.
And that is the podcast that you also host yourself, right? Bigmikefund.com?
Yeah, it's a landing page. So from there, you could click on go on the podcast. You could click to go on a corporate site. You can click to get information on our funds and so on. That is a landing page. We are launching some additional websites, but that's you could schedule time to speak with me. So bigmikefund.com, there is a link there. You click, it'll take you to bigmikecall.com, and that you can schedule time. We can get on a Zoom call and have a quick conversation.
People are seeing a pattern there. Big Mike Call, bigmikefund.com. Awesome.
I don't know, it's sticky. I actually ask CG guys, how should I call my podcast? How should I call? This is a brand, Big Mike something, right? It's so.
And for those of you wondering why we call Mike Big Mike, if he stood up, you would understand why we actually call him that. He's
I'm a big dude. I need to get a little bit smaller. I'm trying to lose a couple of pounds, one of my challenges, but I'm big and tall. So.
Well, thank you so much for your time today, Mike. We really, really appreciate it. For those of you looking, definitely pick up his book. I'm going to say it again. I missed it. What's it? Show it up. Hold it up again, Mike. Where is that book?
So bigmikefund.com. You can also go on Amazon and search for Mike Zlotnik. The book is available on Amazon in Audible, or you could order if you pay for shipping, I'll get you a book shipped. It's like $7, whatever, for the shipping. But you could get an e-copy from Amazon. Bigmikefund.com is another. Just remember that.
And that's the website. That's awesome. Hey, folks, thank you so much for watching another episode of the Shut Up and Do It podcast. And if you guys are looking for more of these episodes and what we do in the greater Boston, Southern New Hampshire markets, check us out at aarealestatementor.com. We'll see you on the next one. Thanks so much.